Treasury yields are climbing, and the reason has as much to do with the Middle East as it does with the Federal Reserve. US government bond yields moved higher in recent trading as investors tracked escalating tensions in the Middle East. That might sound straightforward, but the relationship between geopolitical stress and the bond market is more complicated than it first appears, and understanding it matters right now. Here is the basic mechanic. Treasury yields move in the opposite direction of Treasury prices. When investors sell bonds, prices fall and yields rise. When they rush to buy bonds, prices rise and yields fall. In a classic flight to safety, when fear spikes, investors pour money into treasuries, which are seen as one of the most reliable stores of value in the world. That buying pushes yields down. But that is not what is happening here. This time, yields are going up. The reason comes down to inflation. Conflict in the Middle East raises the threat of disruption to global energy supply. The region remains critical to how the world moves oil. When that supply looks uncertain, oil prices tend to rise, and rising energy costs feed directly into inflation. Traders who see that risk start adjusting their expectations for interest rates. If inflation stays elevated or climbs higher, the Federal Reserve may need to keep rates high for longer. That shift in expectations pushes bond yields up as the market prices in a longer period of tighter monetary policy. This puts the Fed in a difficult spot. Its stated goal is to bring inflation back down to 2% without pushing the economy into recession. Higher energy prices, driven by forces entirely outside its control, make that job harder. For stock investors, the implications are direct. When Treasury yields rise, bonds become more competitive with equities. Money that might otherwise flow into stocks can shift toward fixed income instead. Growth stocks feel this most acutely. Their value is based heavily on future earnings, and those future earnings are worth less in today's dollars when interest rates are higher. So rising yields tend to compress valuations for the companies priced most optimistically. The situation is still developing. Markets are likely to stay sensitive to any new headlines from the region. Two things are worth watching closely in the sessions ahead: energy prices, which will signal how much inflation risk is actually building, and any shift in tone from Federal Reserve officials, whose commentary can either amplify or dampen the yield move. When geopolitics and monetary policy collide, the bond market is often the first place that tension shows up. Watching yields and understanding what is driving them is one of the clearest signals available right now. This briefing is brought to you by First Financial News, clear, daily coverage of the economy and markets at firstfinancialnews.com.